Thank you, Nitin, Anupam, for doing this event here just a few days after the budget was presented in India. To all of those who've got their eyes on the weather in Old Trafford, I think we might still be in for a bit of disappointment with the weather today. But thank you once again for inviting me. I feel a little intimidated speaking before what would be certainly a glittering array of speakers today, starting with our Secretary Economic Affairs, but also leading lights in the world of finance and economics here in Singapore. Thank you also for ICICI for bringing in people from India, because there's nothing like a perspective that comes straight from home. Well, this is a budget that obviously was much anticipated and looked forward to. The background for this budget is, of course, a most astonishing for some people, but predictable for most, a result in the last general election, which returned Prime Minister Modi-led National Democratic Alliance with a stronger mandate and a higher number of seats, 303. It is a mandate which also is backed by an astonishing and a very high level of increase in voter percentage. This is something which is perhaps unique in the annals of electoral history in independent India. So that forms a very strong backdrop to the next 5 years. There is an extraordinary degree of confidence and optimism in the country, a great sense of belief in the leadership of Prime Minister Shri Narendra Modi, and in many ways, as he had entered the Parliament in 2014 riding a crest of support, this in many ways exceeds that, because he's been in office for 5 years and people were voting not just on the basis of hope, as it was in the case of 2014, but also on the basis of what is really a remarkable performance in the course of 5 years. Now, we have seen a number of factors that are quite unprecedented in the course of these last 5 years. One, of course, is that the growth has been quite remarkable. In difficult times globally, 7.5% per year over a period of 5 years. There has been a radical change in the philosophy of governance, in the methods of governance, both at the center and as a sort of a trickle down also at the level of the state governments, in drawing inspiration from what he was doing at the center. There have been a slew of reforms, nearly 12,000 steps for ease of doing business in India, which has taken us from 130 to 77 in the course of just on World Bank's ease of doing business ranking. There's been an unprecedented expansion in infrastructure. The scale of expansion is truly astonishing, and nothing captures this better than the fact that we were building national highways at the rate of 30 kilometers a day, and rural roads at the rate of 135 kilometers per day. But what is perhaps not so noticed here in Singapore and the rest of the world is the transformation that came about in the lives of ordinary people. Because we have been witnessing for nearly 2 decades a fairly high degree of growth, fairly high rates of growth. There were periods of slowdown, but the average rates of growth were very high. But it didn't really translate into a visible impact on the lives of large sections of our population. So here we see the figures speak for themselves. We've built 96 million toilets in the course of 4 years. I mean, bringing nearly 560,000 of the 600,000 villages into an open defecation-free status. We have built 15 million affordable houses in rural areas. 2.4 million affordable houses in urban areas have been handed over. Electricity in all villages. 80 million women given free LPG connections. There has been 340 million new bank accounts, not just a bank account, but a source of dignity and opportunity and identity for so from nearly just 50% banking coverage, we have reached near universal banking coverage, bringing banking and digital, and that has got linked to millions and millions of people coming onto the network in terms of pensions and insurance as well. So these changes have been at the heart of the great transformation taking place in India, and it has given people confidence that it is possible to change lives in the course of a generation or in the course of a decade. But these are figures that usually are not spoken about when economists speak about performances, because we tend to look at macroeconomic performances. But these are also important drivers of the economy. They are important drivers not in just in terms of creating demand, but also in terms of productivity gains, in terms of quality of life, in terms of health, and in terms of the optimism and sentiments it generates in the population. These are very important drivers of the economy. It is against this backdrop that Prime Minister came to the office, and we've just had the first budget that had been presented. But a budget must be seen in a larger perspective. It is at one level just a statement of government accounts, but it is also, because of the fiscal allocations and taxation proposals, an indicator of the direction in which the government wants to take the economy. And it has often been used, not so much lately, but in the past, as a platform for major policy announcements or announcing the direction in which the policy will move. But if you see over the past 3 to 4 years, we've generally had a continuous process of reforms and changes in the policies and regulations. So in that sense, the salience of the budget for that purpose has got somewhat reduced. This budget is a little different, because if you read through the speech, you don't find paragraphs and paragraphs of allocations in various departments and ministries or government schemes. You don't find minutiae about the taxation proposals in the speech. And in that sense, it is far more a reflection of the aspirations of the country and the goals of the government than some of the previous budget speeches have been. But to see this as a budget that is a first budget of the second term would be somewhat fallacious, because to my mind, this is the sixth budget or the sixth annual budget of a continuing process. Because when Prime Minister Modi came to office in 2014, he had a long-term 10-year, 15-year vision of where he wanted to take the economy, where he wanted India to go. And each of the budgets in the last 5 years it links to a budget before and sets the direction for the future. So if you want to read this budget and if you want to see what the policies, do look back on the previous years as well, and you will see a great deal of continuity and evolution. And this is what this is the first point I wanted to make about this budget. And it is also a budget that adheres to and responds to the basic principles that have been guiding his economic thinking. One is that the size of the pie matters, and therefore growth is important. And when he has set the target of $5 trillion, I mean, if you work backwards, you know what rate of growth we need to achieve that. Some may argue that if you look at the capital or savings investment ratios, or if you look at some of the other parameters that seem a little difficult. But look at what it means. First, this is the first time we've actually set ourselves an absolute goal in terms of where we want to reach at a particular point in time. If you are from an organization, you know what that means as a mission statement. You know what that means in terms of mobilizing the nation, the economy, the people, the corporates into achieving, a government into achieving that goal. So this is not just an aspiration, it is certainly one. It isn't just a goal, but it is also a clear direction of where we want to be in 5 years, 7 years from now, and what we need to do as government, as corporates, as enterprises, and as people to enable us to get there. So the growth, this is a very important departure from the past, to set a mission like that. And it will, you'll see, become like Swachh Bharat Abhiyan, like the Clean India, will become a movement in itself. What are you doing? What are we doing to achieve that goal? And that is a very important invisible economic factor in my mind, away from the metrics of numbers, in drive as a driver of economic performance. That's one. The second is that it adheres to each of those sort of other objectives, which is one, inclusion, empowerment, and access. Access for every citizen of the country to the basic needs. As we say that in 75th year of independence, we must each have a roof over our head that has electricity, a gas connection, and a toilet in the house at the very least. So that's empowerment of women. And if you think of what we did with Mudra loans in the course of past 5 years, with 190 million loans disbursed, 74% of which have gone to women, that's a huge achievement. So empowerment is the other aspect, access and inclusion. Then it's the addressing the pain points of citizens and businesses. So you talk of it as ease of living and ease of doing business. But it is also something more. It's making the economy more formal, formalizing the economy, assimilating. I mean, you cannot be an economy where, for some wild estimates, 40 to 50% are outside the formal sector. So in using the power of digital technology to ease the pain of living, to ease the pain of doing business, and to make the economy more formalized. And it also has a great impact on growth, on resource mobilization, and in the kind of multiplier effect you can generate as a result of each dollar of investment that goes into it. And finally, of course, is the employment. And let me therefore just, because you'll hear a lot more, but from my point of view, what are the key takeaways? One, of course, is the great emphasis, continuing emphasis on connectivity and infrastructure. I think the last 5 years has seen us believe that it is possible to expand infrastructure in a visible manner, in a way that you can actually see it. And it has happened across the board in the infrastructure. So connectivity is literally the lifeline, the arteries through which the economy flows. So that's one part of it. Infrastructure expansion, and as you know, we clearly laid out that we need about $1.5 trillion over the next 5 years. And for example, in the railways, you need $750 billion over the next 12 years, which translates to $60 billion a year. And therefore, we are once again talking about public-private partnership model for infrastructure, something that had, in a sense, fallen out of fashion for some time due to our experiences. And there are new instruments that are coming up in terms of securitizing of assets in the infrastructure sector. We've had some great experience in the course of the past 5 years on that. So infrastructure is, again, as you can see in this budget, getting a lot of emphasis. Third, as I've just mentioned, continuing focus on access to basic needs, empowerment of women and youth, and inclusion. And now, as sanitation was a mission for the past 5 years, water will be the mission. And water is not just a mission in terms of making it easier for us to turn on the tap and get water, but look at the downstream benefits in terms of health, in terms of productivity, in terms of just changing the quality of life. And again, you've seen this reflected in the budget. Fourth is the agriculture. Now, if you see the past 4 or 5 budgets, what has been the focus? It's been on credit, insurance coverage, irrigation, market integration, and minimum support price, ensuring a certain degree of comfort and assurance for the farmers, particularly because of the events that are outside their control, the market trends outside their control. But what is different is this time there is now an additional focus on enterprise, rural enterprise, and rural infrastructure. So we are now looking for ways in which we can create the same kind of incubators and service support centers that we do for startups in cities. And we're talking about overcoming the fragmentation of land by creating this farmer producers organization. 10,000 of those will be created. That gives the scale necessary to drive up agricultural growth, which is important to achieve that 5 trillion that we are talking about. Manufacturing, I mean, of course, Make in India has been a great priority. I can think of 5 major steps here. One, of course, is with the MSME. You've increased the coverage for lower tax rates of 25%. Startups, every budget has provided something or the other for the startups. And this budget takes it further in terms of various taxation, tax incentives. And startups is not just about those young people sitting in Bangalore with laptops. Startups is really about each village, each small town, creating their own ecosystem of new startups, and it is happening. I can, in another occasion, speak about some wonderful examples from rural India for startup. Then we've, of course, announced that we will provide investment-linked deductions for mega manufacturing facilities in all these sunrise industries of 21st century. We've talked to great emphasis on electric vehicles, both from production incentive and purchase incentive. And finally, of course, the promise to reform those most complex set of labor laws into 4 labor codes. But digitalization, which has been an ongoing thing, that's the next agenda, continues to get emphasis. And if you see what has been happening with digitalization, it's basically 3 things. One is the push from the government, which has been enormous and unprecedented. Second is the incentive. So you're creating platforms across the country, which are on the basis on which, you know, innovators and startups are doing wonderful things. But there's also a question of you changing behavior sometimes by using penalties. So taxation for those who are using too much cash in digital payments, but also incentives for buying equipment that are necessary for digital payment, but also for using. So now, of course, we also will require every company with more than 50 million turnover to ensure that they will receive payments in specified electronic mode. FDI, again, has been, as you know, most of our economy has been one of the most open economies in the world in terms of entry in as foreign direct investment. This takes it a little further in aviation, area of interest to Singapore, in insurance, area of interest to a lot of you over here, reinsurance, insurance intermediaries, and certain areas of media. Also for single brand retail, easing of norms. But the area that I think is particularly significant this time, to me, is the financial sector. So what are the key takeaways in the financial sector? One, of course, is in the banking sector itself. Now, over the last 2-3 years, you've been seeing a combination of steps, which includes injection of budgetary support, plus market mobilization, plus mopping up the liquidity with the bank through issuing of bonds, in a way that there is not an excessive burden for recapitalization of banks on the public. So this year, of course, and the other important measure outside the budget has been the great success of the Insolvency and Bankruptcy Code. We've just can tell you this is the way that it has taken off, and the manner and speed with which the ecosystem has developed, it augurs well for the future. The net result is that in the last 1 year, banks have been able to reduce their NPAs quite significantly by 15 billion. Of course, it's nothing compared to what it is, and their recovery has been about $60 billion in US dollar terms in the last 1 year. And of course, $10 billion government is going to inject into the banks this year. It's the NBFCs that have received a lot of attention. And the NBFCs actually play a very important role, and we know they've been in trouble. But they've taken some very carefully calibrated measures. One, of course, is that RBI is going to be tighter in regulating the NBFC. But the government is also saying that we will give a degree of guarantee and take on some of the risk if banks and mutual funds continue to lend to NBFC, that is by buying their high-rated pooled assets of financially sound NBFCs, in the arcane words of the Ministry of Finance. So that is an important step. Also, exemption from debenture reserve requirements, and the other thing is that how are they going to be taxed for interest income? They've been brought in parity with the banks. That means it's not on accruals, but on actually receiving the interest payment when it's talking about the bad loan. So in some sense, there is an effort to improve the NBFCs, which is a great thing. And the other thing is for the FPIs, the foreign portfolio investors. This is really a bold step that have been taken. One, of course, is that KYC is going to be eased, so that makes it a lot simpler. I mean, I think nothing matters sometimes more than just have no hassles in doing business. So KYC is going to be rationalized and made easier. But more important, the cap of 24% of FIIs investing will be eliminated, and it will be taken up to the sectoral limit. Of course, companies can prescribe lower limits, that's their decision, but you can go up higher. Imagine what it does if you can take it up to 49%, if that is the sectoral cap. The third, of course, is that they can buy into the listed debt securities of InvITs and REITs. Now, REITs and InvITs are going to be big in India. The embassy one that started has done really, really well, and I see a great future in this, and a source of both infrastructure financing and as an instrument for investments in India. And so this is going to be a great development. And of course, the FPIs now, having invested in some of the NBFCs, have been given the freedom to transfer them to domestic investors within the prescribed lock-in period as well. The other important thing that is happening in this, so we've talked about banks, we've talked about NBFCs and FPIs, but it's what the government plans to do with the public sector enterprises. For the first time, we are talking about actually lowering the government holding in disinvestment to below 51%. And then to redefine what government holding will be if it is 51% or more by taking into account the holdings of government-controlled institutions. As it is, many government-controlled institutions are pretty strong shareholders in many of these companies. So that's a very gentle way of reducing government holdings without causing great panic in the overall system. The third, of course, is that going to enforce the norm of 25% public holding. That's important because that will impose a discipline and accountability to the market, which is sometimes missing. And then, of course, allowing foreign investment limits to go up to the sectoral limit for some of the PSUs that are part of the emerging market index. But that's, again, a huge step and enables a gradual process of making public sector enterprises more market-oriented, more accountable to the financial system. And of course, government has set itself a much more ambitious target of strategic divestment, including for Air India, and raising up rupees 1 trillion this year. So this is of course, there is an aspect of in the taxation proposal which has spooked some of the FPIs, but I'm confident that there will be a clarification that was completely unintended, I'm sure, because, I mean, in one hand, you can't give so much for FPIs, and then on the other hand, hit them with a different tax proposal. So let's keep your ears tuned in for that. But there's also some interesting ideas for International Financial Service Center. We've been trying to really develop those, but this year, I think over the years, there has always been some tax incentives every year. This year, it has gone to a much higher level, whether it is in terms of the 100% tax holiday for a period of 10 years in a block of 15, or exemption from capital gain in certain cases, exemption from debenture distribution tax, and also on loans made by non-resident to units located in these International Financial Service Center. But so this is something to watch out for. And the other thing that is happening, and I say this with some experience of dealing with the gift city, is that they're also looking to make sure that the regulatory environment is aligned with international practices, because you can't have something with great tax benefits, but it has so many hoops that you don't want to go through it. So it'll be IFCIs will have to compete with Singapore, will have to compete with Dubai and compete with London. And I think government is moving in that direction. I can't see what the quality of life in some of those cities will be. That's something that is very different. But again, this is an important measure. But one thing that really is new again is government going in for sovereign borrowings abroad. Besides doing something else, deepening the corporate debt market in India. So there is going to be a great focus, great emphasis on the debt market, something that I think the market has been crying out for a very, very long time. And it opens an entirely new opportunity. And that reflects the confidence that the government has in the economy, both domestically and internationally. Confidence also in the exchange rate. I mean, you may have some movements on account of interest rate movements from here and there, but it reflects a degree of confidence. And I'm very confident that given the global market scenario at the moment, given the economic situation in India, given the fact that not only are we headed on the 7 to 8% growth rate, but we're also doing it with growing macroeconomic and fiscal stability. If you look back, in this past 4 years, you see a declining curve of fiscal stability. And last year was 3.4% fiscal deficit. We're going into 3.3%. And with the realistic target, I mean, yes, we can say, will the gross tax revenue grow by 18%? Will the income tax grow by 23%? But if you see the manner in which the tax base is expanding, the manner in which we are working on the GST has sort of improved, and the worst time as far as GST's disruption was concerned is behind us. We've had a 48% increase in the income tax pay, 78% increase in coverage in the last 4 years. These are the strong figures. And so we're confident about the 3.3%. Our inflation rate is, WPI is 4% or below. CPI is also about 3 to 3.5%. Current account deficit, which was 1.9 may creep up a little bit, but in comfortable position. Our debt to GDP ratio, external debt to GDP ratio is extremely comfortable. Sovereign debt is about 5% of the GDP. And our foreign direct investment grew at 6 to 65 billion last year in a global environment where it's generally in retreat. And that again reflects the confidence of the global economy. I've seen some of the responses to the quasi-government bonds that were issued, including the NHAI AAA rated bond last year, which had a huge response from Australian pension funds. So there is a strong support for us. We are confident it will introduce a higher degree of accountability and scrutiny as well on the economic performance. And finally, a little bit about the taxation, on which I think you'll hear more from our tax experts. But broadly, the emphasis is again on ease of paying taxes. Remove the discretionary aspects from it. Remove the interface between the tax authorities and the citizen. Even all of us feel a little sense of dread when we interact with tax authorities in India. Remove the arbitrary elements in it. At the same time, continue to simplify and rationalize the tax structure. It's happening with GST. You've already seen it after the initial announcements. We are seeing that with income tax. Of course, some people might have expected a more ambitious reduction as far as coverage of the lower income tax rate is concerned. We've increased it from 50 million to 90 million turnover for a lower tax rate of 25%. For personal income tax, we just did it in February, so getting birthday gifts in a year is perhaps not on. So the government decided, well, you've just got it, but I'm amazed how people forgot about it. I mean, people say we didn't get an income tax rebate this time until they had to be reminded. You've just got it 3 months back, but that's before the election, But anyway, I think on the taxation front also, there is we're setting up a new committee to look into the direct taxes code, which is a huge new development. I think GST, it bears mentioning time and again. I mean, if you see the number of taxes and the number of different regulations that were integrated into one, in a federal setup, please understand, in a government which there are 29 states, there are states at different levels of development, an economy which has so many different challenges, so many disparities. But it was important to introduce it without waiting for that great perfect solution. We did that. And so I think on the taxation front, we're doing fine. And as we look ahead, you see the drivers of growth are all aligned. The demography, governance, policies, regulation, the scale of ambition, the scale of investments that are taking place in the key drivers of the economy, including in the infrastructure, and the energy and the optimism and the confidence of the youth of India. All of that is now aligned to sustain that high level of growth so that we can reach that $5 trillion goal in our desired time frame. Singapore has been an important partner in our journey over the last 20 years, the largest source of investment. And it isn't just the Singapore-based company. Many global firms manage their India operations through Singapore. And so we look forward to sustaining this partnership in all areas of our development. And I wanted to just do a little bit of our own advertising. We are going to host a mega event in September 9th and 10th, India, Singapore, the next phase, which will be a combination of a business event and an innovation event, which we call the Inspreneur, India-Singapore Entrepreneurship Bridge. And we will have ministerial, official, and corporate and technology representation from India. Please do register and join us. It's going to be 2 days of great conversation, networking, and pitching sessions in precisely those areas that matter most to Singapore-based companies and global companies that are based here in Singapore. Once again, thank you very much. I think I've taken a little more time than I did, but that's what happens when I speak without notes. Thank you very much again for this opportunity. Look forward to getting a feedback today, which is just